Hi, and welcome back to Concierge CPA. I am Juliet, and in today's video, we're going to talk about financial statements, what they are, how they're used, and most importantly, how to read the valuable information they provide. We'll cover the three main financial statements: the balance sheet, the income statement, and the statement of cash flows. We have a lot to cover, so let's get started. You probably heard the phrase accounting is the language of business, but what does that actually mean? Simply put, accounting helps businesses communicate their financial story. Just like language, accounting uses numbers, transactions, and reports to tell us what's happening with a company's money. Financial statements are the primary way businesses share their story with investors, managers, and anyone else interested in understanding how the company is performing. These financial statements break down all the company's activities into clear, concise information, giving us insights into things like profitability, cash flow, and financial health. They help answer important questions. Is the business making money? Do they have enough cash to pay their bills? Are they growing or struggling? Let's jump in and take a closer look at each of these key statements and how they give us a clearer picture of the business's financial health. Let's start with the balance sheet. A balance sheet is a financial statement that provides a snapshot of a business's financial position at a specific point in time. It's also referred to as the statement of financial position, and it's one of the key documents used to assess a company's financial health. Think of it as a detailed picture that shows you what a business owns, what it owes, and the value remaining for the owners at that specific moment. The structure of the balance sheet starts with the business's name at the top, followed by the name of the financial statement. Below that, you'll find the date the snapshot was taken. This is crucial because a balance sheet reflects the financial situation at one point in time, not over a period like the income statement or the cash flow statement. The balance sheet starts with assets. These are all the resources the business owns and controls, which are expected to provide future economic benefits. Assets are divided into two categories: current and non-current. Current assets are those that are expected to be converted into cash, sold, or consumed within 1 year. Examples include cash, accounts receivables, money owed by customers, and inventory, products the company plans to sell. Non-current assets, on the other hand, are long-term investments that will be used for more than 1 year. These include property, plant, and equipment like buildings and machinery, as well as intangible assets like patents and goodwill. The value of these assets shows the full extent of what the business owns and can use to generate future profits. After the assets, we have the liabilities. These are what the business owes to others. Liabilities are also divided into two categories: current and non-current. Current liabilities are obligations that must be settled within 1 year, such as accounts payables. This is money owed to suppliers, for example. Short-term loans and wage payables, which are salaries owed to employees. Non-current liabilities represent debts or obligations that are due beyond 1 year. This might include long-term loans, bonds payables, and pension obligations. Liabilities indicate how much of the business's resources are tied up in what it owes, and they play a major role in assessing the business's liquidity and risk. Next, we have equity. The equity section represents the ownership interest in the business. It shows the residual value that remains after all liabilities have been paid off. Equity is what's left for the owners or shareholders after the company settles its debts. Owner's equity includes the original investments made by the owners, often referred to as capital contributions. It also includes retained earnings, which represent the cumulative profits the business has earned and kept rather than distributed to owners as dividends. This shows how well the business has been able to grow its value over time. If we collapse the balance sheet into its core components, we can see that the total equity reflects the value the owners hold in the business. Notice that the total assets always equal the sum of total liabilities and equity. This is known as the fundamental accounting equation. Assets equals liabilities plus equity. This equation must always be in balance because every asset the company owns has to be financed either by borrowing, a liability, or through the investment of the owners, the equity. For example, if a business has 169 million in assets, it will also have 169 million in combined liabilities and equity. The equation ensures that the business's financial position is accurately reflected. What does this all mean? what else is the balance sheet telling us? Let's look at Cookie Delight, which has 7.8 million in assets and 2.3 million in liabilities. This means that the company owns 7.8 million in resources, but it owes 2.3 million in debts. After paying off its liabilities, the remaining value or equity is 5.5 million, the portion of the company that belongs to the owners. A strong balance sheet indicates a business with a healthy mix of assets and manageable liabilities. It shows the company's ability to sustain operations and grow, while a weak balance sheet may raise red flags about excessive debt or insufficient assets. Next, we have the income statement. The income statement, also known as the profit and loss statement, provides a comprehensive summary of a company's revenues and expenses over a specific period of time. While the balance sheet gives a snapshot of a company's financial position at a single point in time, the income statement captures the financial activity of the company over a defined period of time, such as a month, a quarter, or a year. It helps businesses, investors, and stakeholders assess how well the company is performing in terms of generating revenue and managing its expenses. The income statement typically starts with the header, which indicates the period the statement covers, such as for the year ended December 31st and the year. This gives context to the financial performance being reported. In the body of the income statement, you will find a breakdown of the company's key financial activities during the period, including revenues. This represents the total income the company earned from its core operations, like selling products or services. For example, Cookie Delight reports $10 million in revenue from selling cookies. This is the top line income, and it provides insights into the company's sales performance. The income statement will also include the cost of goods sold, which is the direct cost associated with producing or delivering the product or services the company sells. For example, Cookie Delight cost of goods sold include the cost of ingredients, labor, and packaging, amounting to $3.5 million. Subtracting the cost of goods sold from revenue gives you the gross profit. For example, Cookie Delight has $10 million in revenue and $3.5 million in cost of goods sold. Its gross profit is $6.5 million. Gross profit is a critical measure because it shows how much the company makes from its core operations after covering the direct cost of production. Next, we see operating expenses. These are the ongoing costs associated with running the business, such as marketing, salaries, rent, and administrative expenses. For example, Cookie Delight have $2.4 million in operating expenses. These costs are essential to keep the business running, but are not directly tied to production. After subtracting operating expenses from gross profit, you get the operating income, also known as EBIT, or earnings before interest and taxes. This is an important measure of profitability as it reflects the company's ability to generate income from its core business operations, excluding any non-operational factors like interest payments or taxes. Next, we have other income and expenses. This section includes income or expenses not directly related to the company's main business. For example, Cookie Delight receives an interest payment of $150,000. Next, we have net income before taxes. And finally, you arrive at the net income, which represents the company's total profit for the period. For example, after subtracting taxes and interest, Cookie Delight's net income is $3 million. This is the bottom line of the income statement and reflects the company's overall profitability. The income statement is often referred to as the statement of profit and loss because its primary focus is on determining the company's profit over a period of time. Profit is a key indicator of a business's financial health and its ability to generate returns for owners or investors. However, it's important to remember that profit doesn't always translate directly into cash flow. A company might be profitable on paper, but could still struggle with cash flow if its revenues are tied up in accounts receivable or if it has significant non-cash expenses like depreciation. This is why companies also rely on the cash flow statement to understand how money is moving in and out of the business. And that is our third key financial statement. The cash flow statement is one of the key financial statements that provides an overview of how cash moves in and out of a business over a specific period of time. While the income statement focuses on profitability and the balance sheet shows financial position, the cash flow statement is all about liquidity. How much cash the company has on hand, how it is generated, and how it is spent. Remember, GAAP requires accounting to be kept on an accrual basis, not cash. I have a video on this topic if you need a refresher, and I will leave the link down below. When a business uses accrual accounting, there is a key distinction between profits from the income statement and cash, which is tracked by the cash flow statement. The cash flow statement helps track this movement of cash separately from revenues and expenses. The cash flow statement is divided into three main sections, each providing insights into different aspects of the company's cash activity. It provides insights into how much cash is generated or used by the business during a specific time period. The three sections are operating activities, cash flows from the company's core business activities, investing activities, cash flows related to buying or selling assets, and financing activities, cash flows from borrowing or equity activities. Operating, investing, and financing. The operating activities section shows the cash generated or used in the core business operations. It starts with net income from the income statement and adjusts for changes in working capital, such as increases or decreases in accounts receivable, accounts payables, inventory, and other current assets and liabilities. Operating cash flows includes adjustments for depreciation, which is a non-cash expense added back to reflect the true cash flow, changes in working capital. For example, if accounts receivable increases, it means cash has not yet been collected, so it's subtracted from operating cash flows. The operating section is crucial because it shows how well the company's core activities are generating cash to fund operations and growth. The next section is investing activities. This section shows the cash used for or generated from investments in long-term assets, such as property, plant, and equipment, or acquisitions of other companies. It also includes cash received from the sale of assets. The investing activities section is important because it shows how the company is investing in its long-term future, whether it is expanding its capacity, acquiring new assets, or divesting underperforming assets. Then we have the financing activities. This section shows the cash inflows and outflows related to the company's financial structure. It includes cash received from issuing equity or debt, as well as cash used to repay loans or pay dividends to shareholders. The financing activities section provides insights into how the company is raising capital and returning value to its shareholders, as well as its approach to debt management. At the bottom of the cash flow statement, you will see the opening and closing cash balances for the period. These figures are taken directly from the balance sheets and show how much cash the company had at the beginning and end of the period. For example, opening cash balance of $500,000 and a closing cash balance of $3 million. This shows a net increase in cash of $2.5 million. The net cash flow from all activities, operating, investing, and financing, should reconcile with the change in cash from the beginning to the end of the period. So here are some key takeaways. The cash flow statement is crucial for understanding a company's liquidity, its ability to generate cash from core operations, and how it manages its investments and financing activities. While the income statement tells you whether the company is profitable, the cash flow statement shows whether the company can convert those profits into cash. A healthy cash flow is vital for sustaining operations and fueling growth. And that is all for today's video. I hope this helped you better understand financial statements. If you find this video helpful, be sure to like, subscribe, and hit the bell so you won't miss the next one. If you have any questions or thoughts, leave them in the comments below. Thanks for watching, and I will see you in the next video.